All right, welcome to this week's Simple Market and Economic Update. My name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning. And in this video, we're going to talk about how the current market and the economic environment is affecting retirees today. And we're going to talk a little bit about the 2.5%, whopping 2.5% cost of living adjustment that's going to be coming to Social Security for 2025. So those that are either planning for or already in retirement are facing challenges due to recent economic conditions, including high inflation and market volatility, leading to concerns about whether their savings will last. And I have some clients that are really feeling this cost of living increase over the last few years more than others. But regardless, if you're somebody who wants to make sure your money lasts and you keep up with cost of living increases, then you want to make sure you watch this video. So despite the U.S. stock market recovery and higher bond yields, uncertainties remain around the presidential election, Fed rate cuts, market evaluations, and more. The key is here, you want to build a flexible financial plan with proper guidance because this remains the best approach to minimize retirement risks and maintain your overall quality of life. So over the next few minutes, we're going to discuss a few key facts about saving and planning for a long, fulfilling retirement. So let's jump in. First, this chart shows annual cost of living adjustments to Social Security benefits over time alongside the inflation measure it's derived from, which is the Consumer Price Index for urban wage earners and clerical workers. As you can see, the 2.5% cost of living adjustment that was recently announced for 2025 is lower than in recent years. This reflects a deceleration in inflation since 2022, but may not adequately address rising costs in areas like housing and healthcare. So to put this in perspective, 2022 saw an 8.7% adjustment, the highest since 1981. While these adjustments are helpful, they may not be enough for many households. So this underscores the importance of maintaining an investment portfolio that's properly invested. If you've been investing during this time, your portfolio has probably done great. So this is really important, particularly given the increasing life expectancies and the challenges that are being posed by inflation. Okay, next, a popular rule of thumb for retirement portfolio withdrawals coined by William Bengen is known as the 4% rule. So this rule tried to determine a quote-unquote safe annual withdrawal rate to avoid exhausting savings over a 30-year retirement period. As you can see in this chart, this is based on historical data that shows the worst withdrawal rate would have been 4% historically. This is based on certain assumptions, and it also shows that the inflation-adjusted maximum safe withdrawal rate for a 60-40 portfolio has fared fairly dramatically over many decades. This shouldn't be surprising since market returns have also varied significantly over this period. What we found out is, and even Mr. Bengen has adjusted his safe withdrawal rate percentage, but despite recent market challenges, current safe withdrawal rates remain strong, emphasizing the importance of maintaining appropriate asset allocations for both growth and income in retirement planning. So what I'm seeing over and over is that people are thinking about pulling their money out, putting it in something like a money market or in cash and waiting for the election. Listen, you can do whatever you feel is right for you. It's your money. But over time, elections have not had that much impact on the markets overall. And you have to remember that the markets or the companies in the market, their goal is to make money. And so they're going to find a way to make money, whether there's a Democrat in the White House or a Republican in the White House, or there's a Democrat Congress or a Republican Congress, or if it's blended. That's not really what you should be focusing on. What I really think you should be focusing on is staying calm and staying focused and making sure that your money works for you over time, because you can have a much bigger problem if you take your money out of the market and you miss out on some of the good returns we've had in recent years. So finally, this chart shows average life expectancies for men and women, which have risen dramatically over the past half century, with more people living into their 90s than ever before. This is a fantastic development for some if you have some money, but it also presents challenges for retirement planning because longevity risk or the possibility of outliving your financial resources is a risk that makes it very important for retirees to have portfolios that can generate both income and growth to maintain their quality of life over potentially decades-long retirements, especially as inflation remains a concern. What will happen over the next 10, 20, or 30 years, we really don't know. But what this means is that even during retirement, it may not be enough to only own bonds or cash or just income-generating assets, since portfolio growth is still needed. So it's always important to hold an appropriate portfolio, ideally with the guidance of a trusted advisor. Morningstar recently put out a report showing that most people that owned funds, and this could just be the index funds in any category, underperformed the funds they were holding by about 1%. So a lot of times people will think that paying an advisor a percentage of their portfolio to help them manage that is going to cost them money. Well, the numbers show us that on average it won't. And if you go to Vanguard study, they estimate a good advisor could add anywhere from up to 2 to 3% more average returns with all the advice you're going to get, the tax planning, and the ability to weather through certain storms. So this is where having someone in your corner is highly recommended. And if you ask me, I do recommend you work with a certified financial planner as one layer or one lens, I should say, to review. And then I also recommend you work with somebody who's a fee-only advisor who will either manage your money for a fee or you can pay for advice, but not somebody who's there to sell you products necessarily. While I find that products like annuities and insurance policies definitely have their place, I really recommend that you work with a specialist when working on any of these or looking to buy any of these type of products. And working with someone like a CFP, they're going to be a holistic advisor for you and help you put together a plan that makes sense for your whole financial picture, and then ideally can connect you with the right resources to put those pieces in place. So I hope you found these perspectives helpful on retirement planning. And as usual, we only scratch the surface on these topics. So if you have any questions, you can find me at keepitsimplefinancial.com, and I look forward to speaking with you in the near future.